energy the worst performing sector on the S&P 500 today. Brian Sullivan having a look for us now at what's driving that move. Hey, Brian.
Hey, Wilf, well, what's not driving that move is us driving, I guess. I mean, the recovery may be a little bit slower than people think. That's one of the factors. All right, let's go through really the four things that are going on with oil and oil stocks. At number one, many people you talk to will say, listen, the recovery is already priced in. How much more do we want here? We're not going to get back to 100% normal anytime soon. This has come far, fast, and that's already priced in, number one. Number two, jet fuel. It remains weak. Jet fuel is about 30% of total global demand for the use of refined products. Guess what? Yeah, those TSA numbers, they're coming up, but they're still down 95% from this time last year. Inventories, don't lose sight of that. They are still high. Are they topping over the tanks? No, but they're still very close to that. More oil, by the way, continues to be imported into the United States. And from an equity point, guys, you got some stocks, not all, but some that are not only at, well above their analyst targets. You got ExxonMobil pretty much sitting at the average target. Occidental is $5 a share higher than the average target price of analysts. Look at the indexes and the ETFs that are getting whacked today. The XOP, it is down 8% exactly, but the OIH, that's much worse. The OIH is a smaller ETF, mostly composed of smaller services companies. So if you don't believe there's going to be a production recovery, avoid that ETF because those are the companies that get paid when the Chevrons and the Exxons spend more. Capital spending, guys, as we all know, has come down. That's almost all services companies. That's why that is down there. But again, we have come back pretty quickly. The average big cap stock in energy is up 38% this quarter, despite the fact that a few days ago, the EIA cut their demand for 2021 forecast for the second time. So we look out, guys. We look at demand. Yeah, it's getting better, but we got a long way to go. Supplies are still high, and it's spooking the energy market today. By the way, if you tuned into our CNBC Pro event Tuesday, the guest that we had on said short oil and oil stocks, and he's an oil investor. I guess he's done pretty well.
Well, indeed. Great timing on that particular call. Brian, my quick follow-up question, as you mentioned some of those smaller names. Back in March, there was a big question mark about whether they'd survive or not. Has that risk itself gone up over the course of the last couple of days, or are we really just tracking, the equities just tracking what the oil price is doing, which, as we said already, is down sharply 10% or so today?
It's a great question. I would say, and we talked about it on that Pro thing again, but I would say the risk of bankruptcies has not slowed at all because the way oil companies work, and I'll be very quick here, is that twice a year, banks come in and they look at the value of their reserve assets, the value of the oil under the ground. We literally just got through that first cycle when this COVID hit and oil prices collapsed. So, companies were able to sort of maintain that 6-month reserve value on their books. If oil stays low, guys, then in the fall, when the banks come back in, they're going to say, oh, Frost and Oil and Exploration or Eyes and Oil, you guys are valued 50% too much because the value of your reserves has just dropped by 50%. And now you've broken all these covenants. And by the way, give us our money. So we're going to have to wait until the fall when that reserve thing kicks in, when they go back and look and revalue those oil assets under the ground. That's the key. It's really just kind of the stuff under there, Wilf, that matters. So we got a few more months, but the problems aren't solved.